get another corporate conversation going. KEC International is the next company on our radar. Now, KEC reported a good set of numbers for the second quarter. Revenues are moving higher. The company, however, has flagged off concerns in the railway business with respect to execution. So let's find out more. We have Mr. Vimal Kejriwal, MD and CEO at KEC International, joining in. Sir, thanks so much for being with us. So I think overall, and we're flashing the numbers as you speak. Overall, it was a decent quarter, decent first half. Your revenue in the first half is up about 10%. It's done even better, about 14% in the quarter gone by. But I think the issue is on margins, because for the full year, you've been saying that you want to get to 7.5%. But whether we look at Q2 or the first half, the margin right now is trending a lot lower than that target. So what is the issue? Is it the railway business? Is it something else? If you could just take us through the big picture.
Morning, Surya. Thanks for having me. I think what has happened is we are still maintaining that we should be able to close at 7.5% for the year. And we have also said that at the end of the year, towards, let's say, exit of FY25, we should be anywhere between 9 to 10, which obviously implies that we do expect that the margins in Q2, Q3 would be better and Q4 would be significantly better. Coming to the reason for the margins, if you look at our margins for this quarter, we are at 6.3. Last quarter, with a one-time, we had said 6.5. If you take that one-time off, then EBITDA was 6%. So there has been a growth in the margin quarterly, also year-on-year, as well as quarter-on-quarter. But the issue what we have is that we could have probably done a lot better, both on the growth, because we are guiding for 15% growth for the entire year. And as you rightly said, we're at 10% for the first half. So we do expect a significant ramp up in growth also. However, what has happened in Q2 specifically is if you look at our India T&D business, it's mainly concentrated in Rajasthan and Gujarat. That's where all the renewables are coming. That's where all our orders from Power Grid and all are there. And the monsoon was very, very severe, especially in Gujarat. So there was a considerable, I'll say slowdown in some of our T&D projects, which are obviously at a much higher margin. And secondly, I think the labor shortage, although it has eased out, we were able to hire additionally 4,000 laborers, I'll say technicians in this quarter. We still have some problems going on in the civil side. So these are two reasons why the revenues have come down slightly. It's less than what we were expecting it to grow. Coming to railways, yes, railways has been a pain point. It's recovering now. So I think that's been a little bit of a dampener. But that was on the expected lines. I think the margins have come down mainly more because of the monsoons and the labor shortage, not because of railways.
Mr. Kejriwal, hi, good morning. So you're saying that margins by the end of the year should be between 9 and 10%?
Yeah, Prashant, what we're saying is exit would be around 9 to 10, so which means that effectively FY26 would be between 9 to 10%.
Okay, by FY25 exit should be. So by the first quarter of 26, you should be in that range.
Yeah, it should be in that range. Yes, that's our expectation.
Okay. What about ordering, Mr. Kejriwal, if you can give us a sense? How has ordering been? I mean, I have the numbers here. 13,500 crores year to date. Your total sort of full year FY25 guidance is 25,000 crores. What are you seeing out there in terms of ordering? And can you exceed this the guidance, the 25,000 crore number?
I don't know whether we'll exceed. We have an 8,500 crores of L1 also. So I think reaching 25,000 should not be a major issue. Whether we can exceed or not would depend upon, I'll say T&D is doing well. Out of the 13,500, 70% was T&D. So I think T&D will do well. Civil is where we are seeing, I think as you're aware, private capex is hardly picking up, although we have got a couple of L1s now in private capex. So it would actually depend upon how the civil pans out and whether we'll be able to, go beyond 25. But I think 25, we are pretty comfortable.
Hi, Mr. Kejriwal. Good morning. Just moving away from your operational performance, what about that asset, ITD cementation? The street believed that you were interested. Now that asset has gone away. What happened? Where did the talks get derailed?
No, I think it's a normal transaction where we were, I'll say, amongst other things, we were looking at that also. So I think someone else has taken it. It's as simple as that.
So what about the other asset then? How aggressive are you in terms of bidding for that other asset? Could you help us out with the size of that asset as well? And by when can we hear about it? As you said, there are other assets. So you're interested in a couple of them. By when can we hear something, sir?
I think they are still at a preliminary stage. So I think it's too early. And we are looking at very niche assets to add capabilities in, let's say, in civil or somewhere in international market, etc. So those are under discussion. So I think it will take some time. I think too early.
And you've already raised some money. Will you look to raise more money?
Not at the moment, no. I think we are very clear that at that point of time, Nigel, we had said that we had taken an approval if we get into an inorganic one. And for organic, we said around 100 million, which we have done.
Okay. Mr. Kejriwal, just to press on that earlier point about railway projects and water projects, is there, I mean, are you going to go slow in terms of bidding for work in these two segments? And is it a temporary slowdown you're seeing? What exactly are you seeing, sir, here?
So railways, we have already gone slow. If you look at our revenue numbers, last year we had done 3,100 crores. This year we expect it to be anywhere around 2,500 crores of revenue. Our order intake last year was only 2,000. This year till now is around 13 or 1,400 crores. So at the moment we are slow. However, what we are now seeing is that government emphasis on infra is in the railway infra is slowly improving, reducing more from the Vande Bharats and more on the infrastructure. In fact, last month they have come out finally with 8 or 10 Kavach tenders also. So if there are items or projects which interest us, like Kavach or signaling, etc., then we would look at it. Hopefully, we should start seeing some improvement in the railway order intake or revenues from next year. I don't see it happening this year because the tenders have just come out, so I don't think they'll get decided. So we are not writing it off. The business will pick up. There's enormous opportunity. We had our own problems as well as the problems with the change in the contractual terms, the counterparty, etc., which I think is getting slowly resolved.
So you're saying that broadly, from a government side, apart from what you went through, the focus was on train sets, these Vande Bharat trains, and not so much on building out the other railway infrastructure, where a company like you would come in. But that focus is coming back.
So what had happened was that when there was so much of emphasis on the trains, we were, sort of not allowed to work on the contracts. You were promised a 7 or 8 hour block on the railway line saying, okay, you'll be allowed to work for 8 hours in a day. And because of the trains part of it, you were allowed only 1 hour a day. Okay. So the projects got delayed and your costs increased, etc. However, now we are seeing a lot more focus coming up, saying because I think everyone has realized that infra needs to be built. So, and also there is a change in our strategy where we have sort of shifted from working on the tracks to, let's say on the Kavach or on the signaling system, etc., which does not entail stoppage of trains. Okay.
Yeah. Okay. Just very quickly, one last point, sir, on this ratings downgrade. CARE, I think, came out with a downgrade on both the long and the short-term debt ratings. And I'm going through their sort of release. They said that higher debt levels, moderate profitability is leading to a deterioration in the debt coverage. Just your thoughts on this, on, what is the debt right now? What are the payouts due? And, would you want to bring down the leverage level? And whether this downgrade, if at all, whether that will have any implications in terms of your funding costs?
No. So, Surabhi, this downgrade happened a couple of months back. And to me, they jumped the gun. We had told them that we are coming out with a QIP. And that's what they mentioned in the rationale also. That once the QIP happens, the numbers will go improve. But anyway, it's their call. Now with the QIP, all the ratios have in any case improved. And as I guided just now, the margins are improving. So whatever impact, and I don't think we had any major impact of the rating downgrade has already been factored in our costs.
Okay, and the debt to equity by end FY25? Okay.
So let me just give, I think we've not discussed that. So what has happened is our debt has come down by 1,100 crores. And if you discount the QIP receipts also, then it's come down by 250 crores year on year. And the interest cost has also come down. Debt to equity is pretty, see, we hardly have any long-term debt. All the debt is virtually working capital. Okay. So that way there's no long-term debt on my balance sheet at all.
Okay. All right, Mr. Kejriwal, we will leave it on that note. Thank you very much. You have a good day and a good second half. Like you're saying, the second half is going to be looking better. Margins will start improving for KEC International. Well, with that, let's quickly go across to our technical experts.